Welcome to our proactive year-end tax planning ideas for our 2020 workshop. I'm Eric Hoemeyer of the Horizon Financial Group. One of our main goals as a comprehensive financial planning firm is to help our clients recognize tax reduction opportunities, both within their investment portfolios and in their overall financial planning strategies. Staying current on the ever-changing tax environment is really a key component to help our clients benefit from potential tax reduction strategies. It is the objective of this workshop to share strategies that could be effective if considered and implemented before the year end. But please note that this workshop is not a substitute for using a tax professional. In addition, many states do not follow the same rules and computations that the federal income tax rules mandate. Make sure you check with your tax preparer to see what tax rates and rules apply in your state. Our main theme for this workshop is that a proactive approach to your tax planning instead of a reactive approach could produce better results for you. Today's agenda is straightforward. We will first review year-end tax planning. While doing so, we will discuss some tax planning ideas and strategies that you can consider. We believe in educating our clients on their choices. Our goal today is to give an overview of tax planning so that when you look at your situation, you have some strong foundational information to use. Please remember, though, that each taxpayer situation should be looked at individually. The good news is we are available to talk with you about the specifics of your situation. Before I get into the presentation, just a quick note to say and sincerely hope that this finds each and every one of you healthy. We are experiencing a very challenging and unprecedented times. And as we like to say around here, your first wealth is your health. I find it's always important to review that there are 5 key areas of financial planning. They are preservation planning, retirement planning, tax planning, estate planning, and investment planning. Today's presentation is about tax planning, which can also affect estate planning. As a comprehensive wealth management firm, we try to always consider the impact of any recommendation we make on not just one, but all these areas for our clients. Tax planning for 2020 became a little more complicated because of the Secure Act, which signed into law in December of 2019, and the 2020 CARES Act added some new laws and rules for taxpayers. Also, with this being a presidential election year, it is helpful to consider some of the tax proposals that are being discussed so that you can plan in an informed way. Let's start by quickly distinguishing the difference between tax planning and tax preparation. Tax planning is looking ahead before year end, whereas tax preparation is filling out your tax forms after year end. This workshop is about tax planning, not tax preparation. It is about hearing some proactive ideas that you can consider now to potentially reduce your taxes. One of our founding fathers, Benjamin Franklin, is credited with saying, "By failing to prepare, you are preparing to fail." For 2020, there are still 7 tax rates. They are the 10%, 12%, 22%, 24%, 32%, 35%, and 37% brackets. Under current law, this 7-rate structure, which was created by the Tax Cuts and Jobs Act, is scheduled to automatically phase out on January the 1st of 2026. Here are the current tax rates for married filing jointly and single filers. Married filing jointly has lower rates on many amounts. For planning purposes, something you need to remember is that even if no changes are made in tax rates, in 2026, the law says we go back to the older, higher rates. Tax brackets are important, and current tax laws call for a sunset in 2026, which means we go back to the older, higher rates automatically in 2026. When thinking about your plan, please remember this. As the arrow shows, for some people, that means income would be taxed today at 24%, would be taxed in 2026 at 33%, a much higher rate. For 2020, the standard deduction amounts are $12,400 for individuals, $24,800 for married couples filing jointly and surviving spouses, $12,400 for married couples filing separately, and $18,650 for heads of household. So how should you view itemized deductions if you do not take the standard deduction? The old rule was to accelerate or realize deductions and take them as soon as possible. With the higher standard deductions now, the new rule is to time or plan deductions. Two of the more widespread deductions that taxpayers look at if they choose to itemize and not use the standard deduction are the mortgage interest and state and local taxes, also known as SALT. Under the new rules, for mortgages taken out after October 13th of '87 and before December 16th of 2017, mortgage interest is fully deductible up to the first $1 million of mortgage debt. That threshold has been lowered to the first $750,000, or for married couples filing separately, $375,000 on homes purchased after December the 15th of 2017. For those of you with mortgages, my advice is to check with your local tax preparer and how much of a deduction you can take. The Tax Cut Act also limited state and local income, sales, real and personal property taxes, the SALT deduction, to a maximum of $10,000. One strategy for those taxpayers who like to give to charities is to consider bunching charitable contributions. Here's an illustration of how that could work. If you are married, filing jointly, and had $10,000 of state and local taxes, which includes, of course, your property tax, and $5,000 of mortgage interest, and you also give $10,000 to charity and have no other itemized deductions, then you would have itemized deductions of $25,000. The standard deduction for you is $24,400. So you would gain $600 by itemizing an additional deduction. In a 35% federal tax bracket, that is an after-tax savings of $210 for you. If you were to do that for 3 years, that would be worth $630 of additional tax savings. However, as an alternative strategy, gift $30,000 in 1 year to the charity, and then use the standard deduction in years 2 and 3. That would bring your deductions to $45,000 in year 1 and save you $7,210 over the standard deduction in that first year. Again, at that 35% tax rate. By doing this, you would lose the additional $210 in tax savings in years 2 and 3 that you received in the other scenario. But your total tax savings is $7,210 versus $610 which is $6,580 more. Now you might be thinking, boy, $30,000 is a lot to give in year one. So let's look at how a donor advised fund, or a DAF, works. If you place the $30,000 in the donor advised fund, you get the tax deduction immediately, and then you can give the charitable contributions as you see fit. In this example, we showed, again, given it in 3 years, that the charity actually received the contribution, but you got the tax deduction up front. If you have any questions on this, or you want to discuss the strategy, please call us. Something that the CARES Act offered that is new for 2020 is a new charitable deduction available to taxpayers who do not itemize their deductions in 2020. This new benefit, known as a universal deduction, allows for an above the line, or before you calculate your taxable income, charitable deduction of up to $300 per individual, $600 for married filing jointly. To qualify, the charitable gift must be cash, or cash equivalent, made to a qualified charity, a 501c3 charity. This contribution must be made on or before December the 31st of this year. As this draft 1040 from the IRS website shows, this deduction can be taken before you calculate your adjusted gross income. So if you're not itemizing and did not last year and like the idea of giving to charity, please consider using this deduction and remind your tax preparer that you did. Qualified charitable distributions, a QCD, are a strategy for retirement savers. As part of the SECURE Act, the required minimum distribution, or RMDs as we like to say, were changed to start at the age of 72 instead of age 70 and 1/2. Also for 2020, the CARES Act allowed you to skip or not have to take an RMD in tax year 2020. However, the qualified charitable distribution, this is a law provision that allows retirement savers over the age of 70 and a half to directly distribute up to $100,000 a year to eligible charities straight from their retirement accounts and not pay tax on this distribution. One idea that experts suggest is, if you are charitably inclined, consider using part or all of your required minimum distribution for a qualified charitable distribution. Like many of the other strategies we are discussing here today, this is one you should see us about if you are interested in evaluating your situation. In 2020, long-term capital gains still receive a tax break versus ordinary income rates. Here you see there are 3 tax brackets for capital gains: 0%, 15%, and 20%. One of the planning items that many taxpayers think about as they get into the year end is the harvesting of taxable gains and losses. Harvesting capital losses is a strategy that has a taxpayer selling assets that are at a loss to offset capital gains. It reduces or eliminates the tax on current capital gains. On the surface, tax harvesting produces an economic benefit equal to the tax saved. As a note though, what you give up is some tax deferral opportunities, and that may be valuable to you at some point. Please note that capital losses are highly tax effective though if they can be used to offset income taxed at a higher rate. For instance, a key thing to remember is that you can use up to $3,000 in capital loss above capital gains to offset any ordinary income. Also though, as a warning, Watch out for the wash sale rule. This rule prevents taxpayers from repurchasing a substantially similar security within 30 days of selling it at a loss. Now, if you have any questions on this loss or gain harvesting, call us or your tax professional. Capital gains harvesting means taking capital gains in the current tax year. On the surface, it might appear that taxpayers should always harvest gains because of the favorable rates. However, harvesting gains introduces a trade-off between lower tax rates versus the loss of tax deferral. Remember, when taking a gain for tax purposes, although the tax is paid at the lower rate, it is paid sooner. In a few minutes, we're going to talk about some tax policy proposals, but this is timely. So let's look at one of former Vice President Joe Biden's tax proposals that is about capital gain rates. The proposal is to eliminate the preferential rate for long-term capital gains and qualified dividends on income over $1 million. This is a significant proposal and a fundamental shift because capital gains rates have never been eliminated for any taxpayer. This proposal is for those affected, basically an increase from a 20% to 39.6% rate. If it looks like it would become enacted, then at today's lower rates, some people could sell assets. Let's look at how this works. Old 2017 rules had 3 rates for long-term capital gains and qualified dividends. In 2020, still, we have 3 rates for long-term capital gains and qualified dividends. However, in 2022, this could bring 4 rates for long-term capital gains and qualified dividends. Therefore, we need to continue to follow the tax law changes and proposals. Remember to review your year-end retirement contribution planning. Here are some contribution plan maximums that could be applicable if you are participating in one of these plans. And remember, all these charts, these detailed numbers are available to you in my September year-end tax planning newsletter that went out a couple weeks ago. Another critical area to review before year-end because of the SECURE Act is what we refer to as overall family tax bracket management. Logically speaking, if you are in a higher tax bracket than your beneficiaries, then it might make sense to let them take distributions after your death in their tax bracket rather than in yours. However, if your beneficiaries are in a higher tax bracket, then it might make sense to take distributions in your bracket before death and then to convert these accounts to Roth IRAs and leave your beneficiaries an account that still must be taken out in 10 years but can grow tax-free until then. An annual step to consider is to review your marginal tax bracket and your beneficiary's marginal tax rate. Again, do this each year. Some benefits from Roth IRA conversions include they lower your overall taxable income long term. Roth IRAs do enjoy tax-free compounding. Roth IRAs have no required minimum distributions impact at age 72. You do not have to do anything with them. Roth IRAs allow tax-free withdrawals for beneficiaries. Qualified tuition plans, also named 529 plans, are a great way to tax efficiently plan for the financial burden associated with paying for tuition of children and grandchildren. Originally, earnings in a 529 plan could only be withdrawn tax-free for use in qualified higher education at colleges, universities, vocational schools, and other post-secondary schools. However, the rules changed that so now a 529 plan can also be used to pay for tuition at an elementary or secondary, public, private, or religious school, up to $10,000 a year. Now, unlike IRAs, there is no annual contribution limits for a 529. Instead, there is a maximum aggregate limit, which vary by plan. Under federal law, 529 plan balances cannot exceed the expected cost of the beneficiary's qualified higher education expenses. 529 plan limits vary by state, ranging from $235,000 to $529,000. Now, some states even offer a state tax credit or deduction up to a certain amount, and fortunately for many of my clients who reside in Missouri, that is the case here. Contributions to a 529 plan are considered completed gifts for federal tax purposes. So in 2020, up to $15,000 per donor per beneficiary qualifies for the annual gift tax exclusion. Excess contributions above $15,000 must be reported on IRS Form 709 and will count against the taxpayer's lifetime estate and gift tax exemption amount, and that currently is $11.5 million. There is also an option now to make a larger tax-free 529 plan contribution if the contribution is treated as if it were spread evenly over a 5-year period. For example, a $75,000 lump sum contribution to a 529 plan can be applied as though it were $15,000 per year, as long as no other gifts are made to that same beneficiary over the next 5 years. Grandparents sometimes use this 5-year gift tax averaging as an estate planning strategy. If you want to explore using or setting up a 529, it can be confusing, so call us and be happy to assist you. Let's talk about annual gifting now. You may gift up to $15,000 tax-free to each donee in 2020. This annual exclusion gifts do not reduce your lifetime gift tax exemption. This annual exclusion gift is doubled to $30,000 per donee for gifts made by married couples. You can also help someone with medical or educational expenses without incurring gift taxes. There are opportunities to give unlimited tax-free gifts when you pay the provider of the services directly. Medical expenses must meet the definition of deductible medical expenses. Qualified education expenses are tuition, books, fees, and related expenses, but not room and board. You can find the details, qualifications in IRS Publication 950 and the instructions for all this on IRS Form 709 by going to www.irs.gov. A wealth transfer planning item to think about is the exemption amounts currently in place for gift, estate, and generation skipping taxes of $11.58 million and doubling that for married couples with proper planning to $23.16 million. Now, any amount over that is subject to a 40% federal tax. However, this high amount provides high net worth individuals a significant planning window and to make up some gifts and set up irrevocable trust. As a reminder, as of now, in 2026, the estate tax exclusion will return to $5.49 million, which is $5 million adjusted for inflation. And again, you could double that for a married couple. On November the 26th, 2019, and this is key, the Treasury Department and the Internal Revenue Service issued some regulations that confirm that individuals who take advantage of the increased gift tax exclusion and portability amounts in effect now from 2018 to 2025 will not be adversely impacted when the sunset occurs on January the 1st of 2026. So if you have a large estate, give me a call, give us a call to discuss this and the techniques you could use. While the election is in November, Democratic Party nominee Joe Biden has released some possible tax law changes he would like to see enacted if he wins the presidency. While these would be future changes, obviously, and must be approved by Congress, to help you think about your planning and future strategies, here are some tax proposed changes we are aware of. First being that the corporate tax rates would increase from 21 to 28%. An increase of the marginal tax rate on top earners from 37 to 39.6. And as we mentioned before, a raise of the capital gains tax rate on filers with incomes above 1 million to 39.6. A limit on itemized deduction. Mr. Biden's tax plan includes a cap on itemized deductions of 28%. This means on each dollar of itemized tax deductions, including charitable contributions, I might add, a taxpayer or couple filing jointly would only receive the maximum benefit of a 28%, even if the filer is paying at a higher marginal tax rate. There'd be a phase out of small business income deductions for those earning over $400,000. And this would be a big one. This is a big one in my practice would be the elimination of the step up in basis. Now, a step up in basis refers to the cost basis of assets or property transferable to an heir upon death. If, as an example, an individual purchases a home for $300,000, but it is worth $600,000 at the time of their death. Today, their heir or heirs would pay capital gains on anything over $600,000 if the home were ever sold. Under Mr. Biden's tax proposal, if that came to pass, the heirs would not inherit a stepped-up cost basis to pay their taxes on. Rather, they would pay on the original basis, so any gain over the original $300,000. Additionally, look to reduce the estate tax exemption to $3.5 million immediately. This means estates over that value would be taxed. Obviously, this is a proposal. Again, just what we are hearing, but thought it would be helpful information as you plan your future tax years depending on the election outcome. In summary, here are some items that you should review prior to tax time. What is your tax bracket? Do you take standard or itemized deduction for your timing purposes? Capital gain or loss harvesting? Retirement planning contributions? Education planning opportunities? Charitable gifting planning? And estate tax planning opportunities. It's also helpful to think about tax planning for any major financial or life events next year or in the future, as well as planning for any other personal situational concerns. As mentioned earlier in this presentation, our tax report for year-end tax planning is currently available. And as we said when we started, a proactive approach to your tax planning instead of a reactive approach could produce better results. So again, if you know of anyone who could benefit from our tax report or from this workshop, please pass it on and let us know. We enjoy helping others and always consider an introduction to others to be the highest compliment we can receive. Thank you for your time today. Again, our goal is to help you. We appreciate the opportunity to be able to assist you with your financial needs.